point 4 of a downtrend, the probabilities are decreased. We know downtrends, right? Uptrends, downtrends. We know how to draw them, number one. I hope you guys know how to draw them, number one. If not, we'll dive into that here in a moment. We know strategies around uptrends and downtrends. We have downtrend rejections. We have uptrend support for bounces. We have cracks of uptrends for the dump. We have breaks of downtrends for the spike, right? There's so many different types of strategies around trend lines. And so one of the most popular strategies that we teach in this community, I call it the 3X trend line. 3X trend line. It's basically the stock hitting the trend line on the third touch, right? So here we have this downtrend on the cues. We can clearly see a high followed by a lower high, and that gives us two valid points to draw a downtrend. And we know that if we come back into this downtrend for the third touch off of a lower low, we know that we can short the stock off that downtrend when it touches it for the third time, if it's coming off of a lower low. And we know that 80% of the time, the stock will hit that downtrend on the third touch and move lower. We know that 20% of the time, it'll come up to that downtrend and start to break above, right? So we already know our stop is if we break the downtrend, our entry is at the downtrend, and our target's that prior swing low. Risk reward is fantastic on these strategies, right? The setup is beautiful. It's an 80-20 setup, high probability setup when criteria is met. And we know that it's an 80-20 setup on point 3. So here we go. Point 3 of the downtrend, that's an 80-20 setup. There's your entry. Stop is if we break the downtrend. Target, a retest of your prior swing low, and then you can hold a runner. So we had a question. If the stock pushes back up to the downtrend and hits it for the fourth time, is it still valid? Is it an 80-20 setup like point 3? Point 4 is not an 80-20 setup. But that doesn't mean it's not valid. It's valid. It can work on out, and it could play on out, but the probabilities are not as high. Point number 4, the probabilities do get reduced just a little bit. Okay, you're looking at like a 60 to 70% chance of the trade working out, right? Right here, there's an 80% chance, statistically, just from past trades, looking at the data, statistically, right? When criteria is met, there is an 80% chance that when the stock hits the downtrend on point 3, it drops, right? We've seen it time and time and time again. When it comes to a point 4, and this right here is point 4, right? Your probabilities do get decreased. You're looking at about a 60 to 70% chance, right, that this downtrend actually gets respected and we see a drop, okay? Point number 5, right, because this is point number 4 right here. So if we come back into this trend line on point number, say, 5, what is your probability of the trade actually working to the downside, right? It's about 50-50. It is truly a coin toss. We can hit this trend line and dump. We can hit it and rip, right? It is truly a coin toss. It is 50-50 on anything after point 4, okay? And that's why we don't really trade point 5, point 6, point 7 unless we have confluence, unless we have multiple separate reasons to take the trade, not just the downtrend. So point 3 of the downtrend, 80% probability, I don't need confluence. If I have confluence, that's fantastic, but I don't need it. Okay, point 4 of the downtrend, probabilities are reduced substantially by about 20%, 60 to 70% of the time it works. So on those trades on point 4, I want confluence. I want there to be multiple separate reasons to take the trade. And that's why we took this trade here on QQQ. We locked in about $200 on that trade, is because we had confluence. Not only was it coming back into this downtrend for the fourth touch, but we have prior support, prior support, prior support. Look at all of this prior support, right? We can clearly see all this support. We pushed on up, we came down, we bounced, we tried to bounce a little bit. We had support, right? We see it very clearly. When you crack support and you push back up into it, what does it turn into? Resistance. What kind of strategy is that? We call that a crack and retest. Stock's cracking support. Stock pushes back up into that support level, but retests it as resistance. Old support turns into new resistance. We crack that support level, stock returns to that level to retest it as resistance. We call that a crack and retest. So now we have a crack and retest strategy, right? Prior support turns new resistance. On top of that, we're back into the downtrend. Those 2 points are at the same exact price, right? Literally, the top end of this range, because I gave us a window and a range of resistance, we came into the top end of that range of resistance, and it lined up with the downtrend to the penny. So now this downtrend that was all by itself, right, 60 to 70% probabilities, right, all by itself without confluence, those are your probabilities. You've just re-increased your probabilities to 80% because you're adding in really good confirmation. Crack, retest, point for the downtrend, back inside this zone, respecting it as resistance, and then getting a nice big dump. You re-increase your probabilities on those trades, okay? So that's why we took that trade, because the probabilities were re-increased for those reasons that we just discussed. Trend lines, you can trade standalone, 0.3 only when confirmation's met, because those do have 80% probabilities. After 0.3, I don't recommend you take trend line trades as, a standalone trade, right? Meaning you're just going to take a trade on 0.4 or 0.5 just because it's at the trend line. I don't recommend that. The probabilities aren't high enough to do so. You need confluence. Here we had confluence, re-increases our probabilities of that trade working, and the risk to reward is freaking tight, guys. Like, the risk reward is so low that it's almost silly to not take the trade, right? Because you're getting in at the top end of that range of resistance. I mean, that's like the highest you want to see it go, because that's resistance. That's the top end of your range of resistance. It just so happens to be to the penny off that downtrend. And so if the downtrend breaks and resistance isn't resistance, like, you can risk like 15 cents, guys. If it breaks the downtrend and it pushes above resistance, you don't want to be in the trade anyway, right? So your risk is super, super low. Our target here on the trade was that psychological 382 level. That's a 6-to-1 setup, right? And let's say you think 15 cents is too tight. Give it 25 cents of breathing room, right? Let's say you wanted to give it 25 cents. You're still looking at a 4-to-1 setup just into your first target. Your final target was low of day. That's a 6-to-1 setup. The risk is low. The reward is high. The probabilities are there. You have confluence. Like, it's almost one of those trades that you're crazy if you pass up on it, in my opinion. Because, I mean, it's such a high probability quality trade. The risk reward is phenomenal. We take those trades, right? All the time. Like, some will fail. You know what I mean? Some won't work out. Some will stop you out for that 25 cents of risk. But let's be real. You're risking 25 cents. You could have won $1.50 to the downside. It's a 6-to-1 setup. If all of these setups were 6-to-1, you could lose half your trades and be right on the other half, right? 50% win rate at a 6-to-1 average risk reward on these trades. You're crushing it. Let's say your average loss was $100. So let's take 10 trades at a 50% win rate, okay? And we know, like, on average, maybe they're 6-to-1s, okay? So 10 trades, 50% win rate. 5 of those are going to be losers. Let's say you're risking $100 per trade. You're risking $100 per trade, and you're losing about half of those. That's $500 that you've lost on the 5 trades. But you're looking at 6-to-1 setups, potentially, right? Let's cut that back. Let's be realistic here, okay? Let's go 4-to-1. Let's really cut it back. Let's say on average they're 4-to-1. That means you're making 4 times your risk on your winners. 50% win rate, what do you have? You have 5 winners. What's 4 times your risk? $400. What's $400 times 5 winning trades? That's $2,000. So you're losing $500 on the losers. You're making 2 G's on your winners, right? At a 4-to-1 setup with a 50% win rate. You still net $1,500 between 10 trades at a 50% win rate. Having dope strategies, really good strategies, high probability strategies, and identifying these setups that have low risk, high reward, right? Here was a 4-to-1, 6-to-1. If that's all you traded, were the setups that had 4 to 1, 6 to 1 potential, and let's say half the trades went against you and the other half went with you, and I'd say that's super realistic. I think it's 70 to 75% of these trades work, but let's just say the market is just it's 50%. Like, you're making money, dude. You're making money at a 33% win rate. You know, that would be 7 losers. That's $700 and 3 winners of $400 on average a piece. Right? That's $1,200 of profit minus 7. You're still making $500, even with a 33% win rate. You could have a really shitty week with a 33% win rate and still be making money. All because you're dialed in, you know the market, you know how to read it, you know setups, low risk, high reward. It's that simple. It's that simple. Don't overcomplicate it, don't stress it. But that right there, again, great topic, you know, regarding like the fourth touch of the trend line. Does it decrease the probability? Yeah, it does. But when you add in multiple separate reasons to take that trade and you have confluence, it just re-increases the probability.